One of the most dangerous risks in investing often starts with something good, a stock that keeps winning. You buy a company you understand, the business performs well, the stock rises, and suddenly that position becomes one of the largest parts of your portfolio. That feels like success, and it is. But there is a second story happening underneath the gains. More and more of your financial outcome is becoming dependent on one company continuing to perform. That is concentration risk. And the uncomfortable part is that investors often notice it only after the stock stops going up. So, before asking whether your favorite company can keep winning, there is another question worth asking. How much damage could it do if you were wrong? That takes us to what concentration risk actually means. Concentration risk means too much of your portfolio depends on the same outcome. The obvious version is owning a huge position in one company, but concentration can also exist across one sector, one investment theme, or even one source of income. And this is where investors can fool themselves. Owning 10 stocks does not necessarily mean you own 10 independent risks. If 7 of those companies depend on technology spending, falling interest rates, high growth expectations, or the same economic cycle, your portfolio may be far less diversified than the number of tickers suggest. Real diversification is not about counting stocks. It is about understanding what actually drives their returns. And concentration can become even more dangerous because you do not always choose it deliberately. Sometimes your portfolio simply drifts into it. Imagine you originally put 10% of your portfolio into one stock. Nothing extreme. Then that stock dramatically outperforms everything else. Without buying another share, that 10% position might eventually become 20, 25, or even 30% of your portfolio. This is portfolio drift. Your investment decision did not change, but your risk exposure did. And psychologically, trimming a winner can feel wrong. The company may still be excellent, the original thesis may still be intact, but the question is changed. You are no longer deciding whether the company deserves a place in your portfolio. You are deciding whether it deserves such a large percentage of your financial future. Those are two completely different decisions, because even a genuinely great company can become a bad portfolio position if the size gets out of control. A common mistake is assuming that a great company deserves an unlimited allocation. It does not. Excellent businesses still face valuation risk, competition, management mistakes, regulatory changes, lawsuits, technological disruption, and simple execution problems. And sometimes nothing goes wrong with the company at all. The stock was simply priced for perfection. This distinction matters. There are really two questions in stock investing. First, is this a business I want to own? Second, how much of it should I own? Investors spend enormous amounts of time answering the first question and surprisingly little time answering the second. But position sizing determines how strongly every mistake affects your portfolio. And there is another complication. You might own several good companies and still be making essentially the same bet. That is where correlation enters the picture. Suppose you owned 5 different technology stocks. On paper, that looks more diversified than owning just one. But imagine that all 5 depend heavily on strong economic growth, expensive valuation multiples, aggressive technology spending, and favorable interest rate expectations. When those conditions change, the stocks may fall together. Different company names do not guarantee different risk drivers. This is correlation risk, and it can create what I would call fake diversification. Your portfolio contains multiple securities, but those securities respond to many of the same forces. The same issue can appear in banks, energy companies, semiconductor stocks, home builders, or almost any concentrated industry exposure. So diversification has to be examined beneath the ticker symbols. But there is an even more personal form of concentration that many investors overlook completely. Your portfolio might be concentrated in the same company that already pays your salary. Employer stock creates a unique concentration problem because your financial life may already depend heavily on that company. Your salary comes from it, your bonus may depend on it, your career prospects depend partly on it. And if you also accumulate company shares, stock options, or employer stock inside retirement accounts, your investment capital becomes tied to the same business. That means one corporate problem can hit two parts of your finances at once. The stock price can fall while job security also becomes weaker. Economists sometimes describe your future earning power as human capital. So when both your human capital and your investment capital depend on one company, your true exposure can be much larger than your brokerage statement suggests. And once we translate concentration into actual portfolio math, the difference becomes impossible to ignore. Here's the simplest way to understand why position size matters. Suppose one stock represents 5% of your portfolio and then falls 50%. Assuming everything else stays unchanged, your total portfolio loses about 2.5% from that position. Painful, but manageable. Now imagine the exact same stock represents 40% of your portfolio. A 50% decline now cuts roughly 20% from the entire portfolio. Same company, same decline, completely different financial outcome. And large losses create another mathematical problem. After a 20% portfolio decline, you need a 25% gain just to return to where you started. So concentration does not merely increase volatility. It can materially change how difficult recovery becomes. And this is why position sizing deserves almost as much attention as stock selection itself. Before we move into how investors can manage that risk, one quick interruption. If this kind of investing analysis helps you separate real portfolio risk from market hype, subscribe to Boring Money Wins and hit the like button. The goal here is simple: make better long-term decisions without pretending investing has to be complicated or exciting. Now, back to the practical question. If concentration matters this much, how much is actually too much in a single stock? There is no universal percentage where a stock suddenly becomes too concentrated. A 5% position may be aggressive for one investor and perfectly reasonable for another. The correct size depends on the rest of your financial situation. Your income stability matters. Your age matters. Your liquidity needs matter. Your tolerance for volatility matters. And your ability to analyze individual businesses matters too. What is more useful than chasing one magic percentage is asking a stress test question. If this position lost half its value tomorrow, would the damage materially change your financial plan? If the answer is yes, the position deserves serious attention. That does not automatically mean you must sell it. It means you should understand the risk you are accepting, because concentration itself is not inherently irrational. There are situations where investors deliberately choose it. Concentration is not automatically bad investing. If you have researched the business deeply, understand the risks, and have unusually strong conviction, a larger position can increase the impact of being right. That is one reason concentrated investors can outperform dramatically. But the other side of the equation is just as important. Being wrong also matters more. This is called idiosyncratic risk that comes from a specific company rather than from the entire market. A concentrated portfolio intentionally accepts more of that risk. The key word is intentionally. There is a major difference between choosing concentration after careful analysis and discovering that one winning stock accidentally became 40% of your portfolio. One is a strategy, the other may simply be neglect. And even if you decide your position has become too large, reducing concentration does not necessarily require selling everything tomorrow. There are several ways to reduce concentration gradually. The simplest is to stop adding money to the oversized position, then direct new contributions toward other investments. You can also reinvest dividends somewhere else instead of automatically buying more of the same stock. Over time, those actions allow the rest of the portfolio to catch up. Another option is gradual rebalancing, trimming portions of the position instead of making one dramatic all-or-nothing decision. Taxes matter here too. Selling a highly appreciated stock in a taxable account can create capital gains, so portfolio risk and tax consequences need to be evaluated together. The objective is not necessarily to punish a successful investment. It is to reduce your dependence on one outcome. And for many investors, broad market ETFs offer one of the simplest ways to build that diversified foundation. An individual stock gives you direct exposure to one business that can produce exceptional returns if the company performs exceptionally. But it also means company-specific problems directly affect your capital. A broad market ETF spreads that exposure across many companies. That does not eliminate risk. If the overall market falls, the ETF can fall too. What diversification reduces is your dependence on the survival or success of one particular company. That difference is important. Market risk cannot simply be diversified away. Company-specific risk often can. This is why a core and satellite approach can make sense for investors who enjoy stock picking. A diversified ETF can form the core of the portfolio, while smaller individual stock positions provide room for higher conviction ideas. Whatever structure you use, the next step is actually measuring how concentrated you are. A useful concentration check does not need to be complicated. Start with your largest position. What percentage of the portfolio does it represent? Then look at your top 5 holdings together. Next, measure exposure by sector rather than just by company. Check whether employer stock creates an additional layer of dependence. Then go one step deeper and look for economic overlap. Do several holdings depend on the same industry cycle, interest rate environment, commodity price, technology trend, or consumer behavior? Finally, imagine that your largest company reports terrible earnings tomorrow and the stock drops sharply. What happens to your total portfolio? If that scenario creates damage you could not comfortably tolerate, you have learned something important about your position size. And that brings us to the main lesson behind this entire discussion. Diversification is not simply about how many stocks appear on your brokerage screen. It is about how many genuinely independent risks your portfolio contains. You can own 20 stocks and still be heavily concentrated, and you can own a smaller number of investments while maintaining broader economic diversification than you might expect. The important distinction is between conviction and exposure. Conviction can help determine what you want to own. Risk management should help determine how much of it you own. You do not need to eliminate every concentrated position. You need to understand what happens if your favorite investment turns out to be wrong. Because long-term wealth is not built only by finding winners. It is also built by making sure one mistake cannot destroy years of progress. That is boring risk management, and boring money wins.